I agree, Matt. Anything in addition you want to mention on the Cred IQ report? This we were looking at this. We talked about huge growth in loan modifications.
Yeah, just this chart.
Yeah,
and
it's
how it shows. This is the cumulative modifications from January 2022 to March 2025, and you see a sharp, not just an incline, but like an accelerating incline. And that's what I wanted to draw attention to is how, modifications have been growing cumulatively, but the rate of their growth is increasing as time is passing, and that to me means that more people are modifying greater values of loans. You combine this with the information from Newmark, and there's a compelling case to be made that people are trying to wriggle out of like unworkable, maybe of very uncomfortable situations.
Yeah.
Some are succeeding, and I bet more succeed than we think. But
what's frustrating about this, again, between looking at the refinance numbers and the modifications, are we just kicking the can further down the road? Because what I think that we have been longing for is some sort of not a absolute inflection point, but at least progress towards enough volume of where we can have some clarity in terms of like price discovery. Yeah. And if we are modifying so much. I mean, we've modified over $40 billion of loans, and we've just modified. Doesn't give us the value, but we just between January and March, we've modified more than 375
like
actual loans, which again I don't know how exactly that much is, but we've refinanced a lot. One example that Credit IQ makes it in a real life case study is, so I'll just read it. A standout example of this trend is the iconic Willis Tower, a 3.8 million square foot office tower in Chicago's West Loop. It was backed by a $1.3 billion loan, interest only. Loan was originally set to mature in March of 2020. So this is a 2020 maturity with 5 one-year extension options. So
do you think they took those extension options?
Well, obviously, yeah. Well, it's 2025. So
yeah.
In March 2025, the loan was modified, pushing the maturity date to 2028. So they already exercised their so like the extensions aren't the modification. The extension is what you already get. That's what you agreed upon in the original loan.
But okay.
And so the modification was after the extensions expired, they were able to get an additional 3 years of extensions. And so now it's going to mature in 2028. And so, again...
Well, my point is like the 1 year extension options, is that standard practice? Like you're just tacking on 5 years, you're going to take it no matter what? Or is it like, all right, here's another year. They're already... This was like they're extending and pretending in those 5 years.
This is not extending... These are not extend. This is not extending and pretending.
That's more like that's... Okay.
No, okay. That's standard. In your loan, you have a built-in extension.
Okay.
The extending and pretending is we have to pretend... is the whole pretending part. It's like the loan doesn't work anymore. Now I have to pretend that it does to give you an extension. Because if I really knew, if we all called it like it really is, we ain't going to give you any more time or money. We're just going to take the property back. Okay. But we don't want to deal with that now, so we're going to give you some extra time. And not just that, they just give them a year, they give them 3 years. Now there's nothing kind of normal about a $1.3 billion loan.
Mm-hmm. So this is more of a bank problem kind of thing, right? If you have a loan that big?
Exactly. This is definitely the bank. The bank. This is everybody's got a problem, but it's certainly a problem at the bank. And so it says that underwriting in February 18, when I think the purchase was originated, the property was appraised at $1.78 billion. As of the latest data, it maintains an occupancy rate of 83% and debt service coverage of 1.32. So, the reason why they were able to modify this loan is because it is actually performing.
Okay.
So in their case, they're like, you're paying your mortgage, sounds good. We'll give you an extra time because in this scenario, again, they don't want the $1.3 billion back. They're getting paid on it. Yeah. They don't to deal with the property. Mm-hmm. This is a client that they don't want. I mean, it's the Willis Tower. We're talking about the Sears Tower here. They don't want to. They want that buyer to go buy another $1 billion property and give them a loan.
Yeah.
So why ruin that relationship if they don't have to? But there are many cases in the multifamily where that DSCR was not positive or it was below 1, and they're still giving. That's the true pretending.
Yeah.
Of like, we're going to pretend like it's okay when it's really not okay, because we just both don't want to deal with it.
Yeah, yeah. That's it. That's interesting. And I also think it illustrates that like a lot of these loans are in office, but and Newmark mentions it, multifamily is a sizable chunk of these loans as well.
The larger percentage of maturities, larger percentage of multifamily are insolvent than office.
Okay, wow.
Yeah.
Yeah, that's really interesting. It is. I think it's increasingly relevant too. And there's another Credit IQ piece of data that we covered about a month ago that talked about rising delinquencies. And these delinquencies are following roughly the same kind of accelerating path that we saw related to loan modifications. This is not a wall that happened and we got over it 2 years ago. We said that there was a low maturity wave in 2023. Well, actually, that was maybe the beginning of a wave. And now it's just still increasing, still a factor.
Trying to flatten the curve. I mean, that's what is going on right now. It's that it was a kind of a peak, and they're trying to get the peak down, spread it out, so the market can absorb it piece by piece, and maybe it's not as bad, as deep as it could be if it's stretched out. But the problem with that is that we can't like clear the market and restart the market and have the market working. The market isn't really working as it is intended, whatever that means.
And to kind of go back to why this is worth mentioning now, you go back to Jerome Powell. He's keeping rates, or the Federal Reserve is keeping rates elevated. This is all a kind of a product of the persistent elevated rates. Yep. And once rates get down to where people are comfortable transacting, then that might go away. But either the rates change or the way we transact change, or there's going to be some kind of crisis or like discomfort, let's just say, in the middle, and maybe even distress. So that's why I think that it is worth watching. It's worth watching because rates haven't changed, which fueled the thing to begin with. Once rates get down, then maybe I'll stop talking about it. But I think it's still worth talking about now. Loan maturities and distress and
I agree. At some point, like, you know, reality, the chickens are going to come home to roost.
Yeah.
You know, and we're going to face reality.
Mm-hmm.
But you know, perception is also reality. So you know, the way
true.
we all perceive it. And
if you're really good at pretending, maybe you can convince a lot of other people to pretend along with you. And
life's a stage.
I guess it's true. You are who you pretend to be.
Yep.